Today, wither house prices. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. It's Friday afternoon and Tarric Brooker's back for another chat. Hi Tarric, how are you doing?
I'm not too bad, Martin. How are you, my friend?
I'm still here, which is always a good start when you think about what's going on at the moment.
Oh, definitely, mate. It's all happening out there. When in Australia, around the world, we've got companies on the verge of collapse. We've got wars, and then there's all the doldrums in the market.
Yeah, well, this is very interesting, isn't it? How the yield curves are now saying, well, hang on a moment, maybe we'll see rates going up and then they'll come back down again.
Well, it's certainly looking that way. I mean, look at the say, for example, the US forward yield curve out to, sort of 2023, 2024, and we're now pricing in, rate cuts, towards the, Q3, Q4 in 2023. So, the market is expecting, this economic expansion that we're currently in to be relatively short-lived in the grand scheme of things.
And I find it fascinating that the Federal Reserve and, in fact, other central bankers are now saying what we need to do is we need to pull demand down to equal supply. So they know that they can't actually tackle supply-side issues with interest rates, but what they're trying to do is to trim demand by lifting rates. Bit of a long bow, in my view.
It is, but it's also the only. I mean, like realistically, it's no different than what they did on the way down. With rates, because there was like, well, fiscal isn't going to do the heavy lifting. We're not seeing the productivity increases that we need to drive economic growth. So they resorted to cutting rates and doing quantitative easing. So I really think that it's just flipped now. It's just that they're once again using the blunt tool, the hammer, and treating every problem as a nail on the way, with the rates on the way up, as they did with rates on the way down. And, just that raises an interesting question because analyst and former hedge fund manager Nick Glinsman did an interview with Blockworks a few days ago in which he raised the possibility of basically a central bank consensus in the developed world, whereby they just go, well, look, we've got to fight this together. We need to fight inflation. We need to agree to do this, and that needs to be our number one job, not anything else. And while that's only speculation, if there's some truth to that, particularly in Europe, for the ECB, well, things are going to get interesting.
Well, I've had the theory for some time that they all got the email from the BIS saying, right, guys, inflation is a task at the moment, right? Because, of course, there is an amazing coherence now across the Western Central Bank and central bankers, both in terms of the language and in terms of the trajectory, in terms of rates. And they're all trying to solve the same problem. Though it's interesting, did you see that in the UK, overnight, they announced that they're going to throw a lot of money at households to try and deal with the power price hikes, so several $100s now. And the interesting question is, isn't that going to be inflationary?
Well, of course, it's going to be, inflationary from the perspective that, inflationary pressures will be greater than they otherwise would have been. I'll make that particular distinction, but the reality is that, I think that it's a good thing that they're helping people who are getting smashed by inflation, because, these people receiving this money are not the people who benefited overwhelmingly, not the people who benefited from the run up in asset prices, from all the various stimulus. These are just people, everyday people living their lives. But there does need to be something on the other side of the ledger that does help to dampen inflationary pressures, whether that's, some form of, tax increase, on the very people who perhaps benefited from all, this huge run up in asset prices, or from something else. I mean, obviously it's a huge debate with, that's multifaceted, and there's, a lot of different options and scenarios, but yeah, I mean, but I honestly think that this is just the beginning of, throwing money at an inflation problem to solve inflation.
Well, it does seem to be, and of course, the money they're throwing, they're giving it to every household. It's not just those who are eligible. In fact, there's two levels. So there's a level of support for everybody, and additional support for those who are actually worse off. And of course, they're paying for it, interestingly, by putting an extra tax on the excess profits from the petroleum sector, which was very un-Tory.
It wasn't. Well, first off, I'll say I wasn't aware that they were just basically giving it to everyone. That seems a little bit, well, a little bit inflationary, shall we say? But I think that the issue with the energy sector at the moment is that it's a really, really complex picture. You've got refineries running 24 hours a day, 7 days a week, but we can't make enough fuel because of all the issues with the war, with Russia, with sanctions, with all these other things. And there really needs to be a greater incentive for them to continue, because the problem is that we've had sort of 10 years now whereby oil companies, energy companies have basically been told that time and time again, your time is coming to an end, you're finished, you've only got X number of years or X number of decades before you're surplus to requirements. As so they've acted accordingly, and now we're seeing the consequences of them acting accordingly. So I don't think there's really any easy answers on this one.
Well, it is interesting insofar that we're being encouraged to invest, particularly, of course, invest in renewables. And now, effectively, although they're being given some tax relief for that investment, they're also being, taken to the cleaners in terms of 25% on profit. So, it just shows you how muddy this all is and how complicated it is, right? And in fact, I want to go to your first slide, because the chart that you've got there, I think, sums it up just perfectly, right? It looks great from behind, but don't look down.
Yeah, it's a bit like that. So we'll get started with the slides then. As usual, they're available at avidcom.substack.com or on Twitter if you guys want to have a look at them. And before we kick off today, I just want to say thank you to everyone who has so far subscribed to my Substack or made a contribution. That really, really helps me and just helps me to dedicate more time to stuff like this. So without further ado, we'll get into housing prices, which is probably why a lot of you are here. And just before we kick off, I've had a bit of a chat with John Adams about his thesis, on which you and him have been exploring in the interest of the people. So I thought it'd be a little bit interesting to just sort of like discuss what I think, what you think, and we'll just sort of go from there if that's cool with you, Martin.
Yeah, absolutely. And with all of these things, there are going to be lots of different theories whizzing around. But I can tell you that prices ain't so good as they were at the moment.
No, certainly not. So this is from Westpac, and it basically shows that where housing sentiment goes is where housing turnover goes. Even if there's a bit of a lag, that's roughly where it goes over time. So we've seen housing sentiment really, really roll over in the second half of 2021 and into 2022, and turnovers following. And the issue for the market here is as turnover falls, as more people list their properties on the market, obviously there's going to be less upward pressure on prices and eventually downward pressure on prices. And that's something that you and Edwin have covered quite extensively in terms of the number of listings in Sydney continuing to rise.
Yeah, so the listings are remarkably high in Sydney, and actually a lot of those are apartments, but now houses coming through too. And I guess for me, the critical indicators are, firstly, what's happening with those listings, and secondly, the momentum or lack of it in credit. So new credit is also falling over as well. So, and I've always had the view that it's the rate of change of credit that is actually the strongest correlator to what happens to house prices ultimately. There's a few other things too, but so all the indicators are suggesting downward drafts rather than upward drafts, and even Christopher Joy was suggesting that prices are on the way down, as he posted today, that prices in Sydney are also sliding. So we can see that things are definitely on the slide at the moment.
Indeed. Now, this is another one from Westpac that it basically further explores that data set, and it just shows that the time to buy a property as considered by consumers is basically at its lowest level in decades, possibly ever, based on their data set. And it just goes to show that that the market is increasingly narrowly based. And on the right there, you've got basically that price expectations are now rolling over to a space which is consistent with the long run average, and even heading below that long run average, which would arguably be heading towards prices falling.
And again, I think it would be very interesting if it was actually shown as a split between apartments and houses, because my data is suggesting that expectations with regard to apartments have already ducked below the long-term average. Houses, not so much. And I think it's very important to sort of understand there's a bifurcation in the market between particularly high-rise apartments and the rest of the market. But averaging sometimes masks some of these things.
No, absolutely. And that's something that we've gone on rather extensively about in recent weeks.
Exactly.
Now, this is from a recent report released by the RBA this week, and I think that it really just goes to show part of the reason why we did see a housing boom from toward the end of 2020 onwards, and it's basically just that the proportion of people living in share houses just really fell off a cliff. A lot of people wanted their own rental property, or they wanted their own home in order to just have space, to have just to have a little bit of more freedom in that regard, rather than sharing a house with a bunch of people. And I think that, and this is just a theory. I don't actually have the data to back this up, but I think that what we've been seeing over probably the last 5 to 10 years, depending on the locale, is basically just deferred household formation. People waiting longer and longer to move out of the share house, to buy their own home, because it is expensive. It's and not only that, but the moment you move out the share house, you move into a rental, the proportion of your income that you can save to so for example, buy a property reduces significantly. So I think that we've seen that consequence of that deferred household formation, and then all of a sudden everyone was like, "Nah, stuff this. I've had enough. I need my own space. I can't deal with these people in the lockdown, whether it's parents or whatever. I have to have my own space." And then we've seen this huge surge in the demand for housing, despite the fact that immigration's gone backwards over the last almost 2.5 years now. So I think that that's really one of the main drivers that we've seen. I mean, obviously, there's the cutting in rates, the TFF, etc. But I think that purely from a sort of underlying demand fundamentals perspective, I think that's one of the reasons why we've seen such explosive demand for housing.
Yeah, and actually another way of looking at that, as I do in my data, is at what age did people get their first house, right? And over the last few years, that age has gone higher and higher and higher and higher. And because we've now got 30-year mortgages rather than 25-year mortgages, it means that more people will be going to retirement still with a mortgage around their neck. That's a very important dynamic that a lot of people haven't really understood yet.
No, and that's something that was, I think, a really understated part of the debate regarding the coalition's proposal to allow people to use their super. Because if you look at, say, for example, the median age of retirement here in Australia today, people are not making it to 67 or 70. Most people will retire sooner than that. Whether it's for health reasons, whether it's because they've got the money, whether it's, for any number of reasons, people will not make it. So if you look at, say, for example, in Sydney, the median age of a first home buyer is now about 36 or 37, depending on which survey you're looking at. You then slap on a 30-year mortgage, which means they're going right up to that finish line when you hit 67 and you get the age pension. Most people are not going to make it that far if current trends continue. They'll retire before that, which means unless they're paying extra on their mortgage, they will retire with debt. And you've got to think that the banks are looking at that and they're going, well, they're going to look at these people's super balances and they're going to go, well, is that person going to be able to pay off their mortgage in their retirement? I mean, it's just it's part of the it's part of the equation at this point, I think.
No, I agree. And interestingly, of course, again, in my surveys, a number of people are assuming that they're going to be able to pull money either out of the property or out of superannuation to be able to pay off the mortgage later. Now, there's a big assumption there about asset growth, both in terms of property prices and indeed in terms of superannuation investments over that period. And in fact, if you look at recent performance, they've gone backwards potentially on both of those. So there's a really interesting question there. And the other question, which is also coming up, of course, as you say, a lot of people are actually retiring earlier, but they're informally retiring. In other words, they sort of can't find anything to find in terms of a job. So they're out of the job numbers, and that's one of the reasons why the unemployment rate is where it is, because there are lots of people who are actually outside the unemployment system because they basically have made a choice, and that choice is not necessarily one that's a free choice. It's because they can't find the appropriate job for them.
Yeah, and that's particularly an issue amongst women over the age of 50. I mean, that's one of the reasons why they are one of the largest recipients of of job seeker. And I mean, it's also one of the reasons why they are overrepresented in the people in the homeless population as well. So, it's not all puppy dogs, fairy tales, and rainbows the way that some in the government would like to think that it is.
Great economic managers and everything is wonderful. Well, yeah, maybe not. And by the way, on that data, the shared house drop is quite significant as well, because what I'm finding also is that people are a bit, interested in terms of, under what conditions they may live. And in fact, that's been exacerbated a bit with the COVID thing. So people are actually, they want a bit more space.
No, absolutely, and just on the you mentioned that you survey people regarding the first home buyer age. What sort of first home buyer ages are we looking at now? Do you break it down? Is it national, or do you break it down by state? Or
I actually have it down to a postcode level, because it's so it varies, right? And of course, in New South Wales and Victoria, it's 36, 37, 38. In Western Australia, it's about 35. In some other states, it's a little lower. So it does vary. And it also varies by whether they're looking at an apartment or a house, and what their family formation structure is as well. But the overall trend is up, and up significantly. So when I started doing this survey, which was in 2001, 27 was the average age.
Wow, that's an absolutely insane change. I'll have to ask you about the data later, because I would love to write an article on that. It'd be fascinating.
No, I'm happy to share that. I mean, it's really powerful data, and it's interesting. I don't know whether you come onto this in your charts, but the ABS published the mix of occupancy types, in fact, in the data yesterday, and they showed that the proportion of people with a mortgage has gone up dramatically. The proportion of people who own their property home free has dropped significantly, and the proportion of people renting has gone up dramatically over the last 20 years. So you can see the structural disruption that we have in the housing sector, and the consequences in terms of people who are mortgaged for longer. And of course, the mortgage is bigger than it was, because house prices have been so accelerated as well. So they've got bigger loans, which is why the debt ratios are all over the place too. So you can just see, as soon as you peel over the onion and sort of get down into the layers, just how dynamically worrying this is, and how so many people are actually wrestling with so many problems to do with housing.
Well, it's a good thing we don't have rising rates, mate.
Oh, phew. Yeah, exactly. Oh, hang on.
Okay, now this is a chart from French's Forest in Sydney of weekly asking property prices, which is from SQM Research. If you want to have a look at your own suburb or this suburb, or you want to just look at different breakdowns, that is free, and there's a link to that on my chart section, so you can play with that to your heart's content. And one of the reasons why I follow this particular postcode and this particular suburb is it's a bellwether. If the market, if sentiment rolls over, or if sentiment jumps, this market will rise, or this market will fall. And the movements are rather outsized and very obvious when they do occur. So say for example, in between 2017 and 2019, you did see that a rather significant drop there in prices. I believe it was around about 25%, which was much greater than the Sydney average. And then you saw in 2019, as a result of the election and everything else, you saw prices jump. And then COVID happened, prices fell. And then later, when we had the run up in prices from the end of 2020 onwards, once again prices leapt. So this is a really, while people are going to be like, oh, you're cherry picking. This is about sentiment. It's not solely about the size of the movements. It's about measuring where sentiment is going in the market. And in this particular market, sentiment is going down rather significantly. Asking prices are down over $440,000 since their peak. So, I watch this on a much more granular level, on a house by house level. And I keep an eye on it through, realestate.com, comparing like with like, and it is showing that the Sydney market is weakening significantly.
When you make the point about realestate.com.au, it's interesting that they've sort of started to remove some of that trends data in terms of prices.
I am a bit disappointed with that, to be honest. I thought it was quite handy having the month-by-month breakdowns, as I could compare with, Domain or any of the other sort of housing price data providers. But, it is what it is, and I won't say too much to get myself into trouble, but yeah, it's unfortunate. It's disappointing and it's unfortunate. I'll put it that way.
Yeah.
But I think that just to sort of round off the discussion here for Aussie housing before we get into stuff in other parts of the world and the other issues that face the market. I think that it really going forward, it all depends on inflation, both in Australia and in the US. If inflation stays strong, if inflation stays high, then, trying to, form a rescue package to cut to negative rates like you and John have been discussing on the interests of the people. I think that's going to be a pretty tough sell under those conditions if inflation persists.
Well, it goes back to what is the central bank's mandate, right? So, they basically have an employment mandate and they've got an inflation mandate. And of course, they've all swung towards the employment mandate previously. That was the reason why they took rates down, and they were happy for rates to be really low. And so, inflation is transitory; it's not a problem, right? And so, hang on a moment, no, actually, it's not transitory. We're worried about inflation, and I keep reminding people, inflation was building before Ukraine hit, right? Wherever you look, you can see the data was already going higher. So it's like Ukraine, sure, it stepped everything up, but it was already going in that direction. So there's some interesting alibis being created to say it's the war what did it. Well, I'm afraid my view is it's much more complicated than that. And now, of course, central banks have swung to, we've got to get this inflation under control because, of course, stagflation is diabolical once it gets entrenched. But there are already second-order impacts coming through. So, for example, high fuel prices feed through into the cost of other goods. And the ABS statistics that came out the other day show that a lot of companies were expecting to lift their prices to their customers as a result of it. And we're seeing that in spades pretty much wherever we look. So already inflation is embedded. So it's really a very significant question to me as to what extent lifting interest rates will be able to quell inflation, or to put it another way, at what point will the central banks be able to say, we've done our inflation controlling job and now we can go back to lowering rates for unemployment purposes. That's the real key question, because if rates go on going up, it's clear to me house prices will stay low and fall. Whereas if they turn turtle and cut rates again and go into negative interest rate territory, prices could rise. So it does come fundamentally down to the control of inflation and the trajectory of interest rates.
Yeah, no, I concur. I mean, if we do get inflation under control and they do decide to pump the market again, as John Adams suggested, on your recent shows together, then yeah, sure. If they take interest rates negative, housing prices are going to move. They're going to go even higher again. But the question is are they going to be able to do that? Is inflation going to be too high for them to even consider that? Because they're going to look really, really dumb, particularly with the oil side of things that we discussed in the last show. If we've still especially once the current fuel excise tax cut passes, if we're looking at fuel at $2.50, $2.60, maybe even $3 a litre, if we go back to oil at $130 a barrel, trying to sell rate cuts in that environment is going to be a nightmare. It's going to be, a political, I'm not going to call it an impossibility because this is Australia and it's an insanely broken country when it comes to housing, but it's going to be very, very hard, a very, very hard sell. And more than that, it's not the RBA that needs to sell it. It's the Fed that needs to sell it. Because if the RBA becomes dovish and they cut the crap out of rates, yeah, sure, they can send housing prices to the moon, but they'll smash the dollar. But it really comes down to the Fed. For example, say right now, gasoline prices are at all-time record highs. And this is with the Strategic Petroleum Reserve throwing a million barrels a day of oil out there, and the Chinese being in lockdown, and you're still seeing fuel prices at all-time record highs. You're not going to be able to sell the Fed doving up to the American people while they're paying record high prices for gasoline and record high prices for food.
No, I agree. We discussed the other day, and I think it's still true that Biden, of course, is seeing inflation as his most critical domestic issue. So it is politicized, firstly, and of course the October-November timeframe for the interim elections is there on the table. So whatever the Fed does before the elections may well be different for what they might do after the elections. But I actually think it's going to be very much more difficult than many people think to get this inflation number down. And of course, in the UK, it's, they're talking about double-digit inflation in the UK now. New Zealand is concerned about it. They put the cash rate up by 50 basis points this week to 2%, and they're talking about more aggressive action sooner to try and actually quell inflation. We've got the Fed signalling probably 50 basis points. And of course, Tuesday week when the Reserve Bank meets here, well, the analysts are saying 25 basis points or 40 basis points. Westpac's saying 40. So we're actually behind the 8 ball anyway, I think, really, with regards to lifting rates. So it's going to be very tough to see anything other than rates going up in the short term. But then the question is, well, will it work or won't it work? We won't know for a few months. But if the disruption from Ukraine continues and the oil issue continues, and look at wheat prices or natural gas prices or fertilizer prices, are all going through the roof. So you wonder just how embedded this is going to be and how those second order issues flow through and whether they'll be able to get it under control.
Yeah, indeed. And there's also the issue as well of US wage inflation, of a wage spiral, because it's all well and good to say, we don't have wage inflation in Australia. It's like, well, congratulations, idiots. You've managed to wreck the economy sufficiently that we can't generate wage growth under ideal conditions. Congratulations. But it doesn't matter. What matters is wage inflation in the US. If they keep having wage inflation issues, if wage inflation continues at high 3s, 4-5%, annually, the Fed's not going to be able to cut rates. They're not going to be able to stop. It's just going to keep forcing them to be hawkish. Now, don't get me wrong. If they want to be complete morons and they want to risk this, an existential crisis for the entire system, then sure, they can ignore the political issues. They can ignore, people throwing Molotov cocktails at the fence at the front of the Fed. If they want to do that, they can. It'd be incredibly stupid to do so, but they can do it.
Well, indeed. But I do think the political overtones are extremely strong at the moment. I guess the other point is that slowly the markets have woken up to what's going on here, right? So, until quite recently, I don't think the markets believed what they're now seeing. And it's interesting that most recently, again, Jerome Powell has been saying, well, we're okay for markets to fall, which is a really interesting observation, right? So the Fed put has definitely been put to sleep at the moment. Now, whether that will change, who knows? But what it tells me is that we can't just think about domestic situation here. You've got to be looking at the US. And I know people get frustrated sometimes about why are we fixated on the US? Well, it's simple. It's by far the biggest, most powerful market. The dollar is the mighty dollar. And therefore, whatever happens over there is going to have a profound impact over here. And trying to look at the local economy without understanding that international dynamic means you're never going to actually get right results in terms of reading what's going on.
Exactly, and that's why when there's nearly always some form of US data point here, here on our shows, when we have our chats. So it's a key part, for better or worse. I mean, sometimes it's a bit painful having to watch it, but it is what it is.
Exactly.
Okay, now this one from the RBA basically shows the debts on the RBA balance sheet, so the TFF funding that they provided to the banks, and also the government bonds that they've bought, both state and federal, that is going to need to be rolled over in the coming years, in 2023 and 2024 in particular. That's a big amount of debt to have to refinance for the banks. It's going to be interesting in that regard, particularly if we do still see inflationary pressures and pressure on yields, because that's going to compress their margins relative to where they are quite a bit.
Well, actually, we're already seeing that. So you may have noticed that Westpac put up their fixed rates this week, and other banks have followed as well. And interestingly, they've started to put up their term deposit rates a little to try and attract more funds in as well, because that's actually quite a cheap form of funding for the banks at the moment, because they are really desperate to not have to access the more expensive funding in the US. And interestingly, the term funding, of course, is split over 2 years. That's because there's actually some different durations in the term funding facility. So it's going to be a big problem. And then the RBA says, well, we're going to let the bonds mature, but that's still quantitative tightening. And there was a presentation from the Reserve Bank, that's where this came from this week, talking about this quantitative tightening. and what it means. But did you see the comment in that presentation relating to the exchange rate? Because I thought it was quite interesting. They were saying
I missed that one.
So they were basically saying we can actually allow the exchange rate to move a little because we're actually going to be doing the quantitative tightening. So they're actually arguing that the exchange rate's been very strong, partly because of the quantitative easing, and if they quantitatively tighten, they can allow the dollar to move. So I thought that was quite an interesting observation.
The dollar is going to be an interesting one to go watch going forward.
Yeah, it is. For me, that's going to be the really critical question, I think.
Oh yeah, well, exactly. I mean, if you start importing inflation, then you're really in trouble at that point.
Yep.
Well, speaking of inflation, this is the manufacturing and service PMI output prices, which is basically what they are selling the products to the wholesalers and to the retailers at. So they are basically just starting to see these price pressures become entrenched over time, and it's really quite interesting to see that even here in Australia, even in the services sector, that inflation is starting to become entrenched in that regard. Yeah,
absolutely, and it's in line, by the way, with what that ABS survey also reported, that it's actually in the services sector where some of these terms are going through. And interestingly, the ABS said, well, it's fuel, it's labour costs, it's input costs, across the board, basically. So it's maybe not surprised that service sectors are now also are experiencing inflation, which is another sign of how embedded it is.
No, absolutely. And just to take another step back on and looking at the broader inflationary picture, one of the big headline things is obviously the US CPI. Everyone goes on about it. It's the big thing. They go, well, okay, it's now coming down. It's peaked. Inflation is going to come down from here. Blah 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 blah. But I personally don't find it all that useful, because you've got all these volatile elements. You've got things like used cars. You've got things like airline tickets, for example. Airline tickets and petrol, gasoline, etc., energy prices. We could easily see another peak in inflation at the end of the year just because of volatile monthly moves in those things. But I was looking at the US producer price index the other day, and I stripped out the volatile things. I stripped out food. I stripped out energy, and I just looked at the core baseline things, inflation impacting US producers. And what I found is that inflation has been bouncing around within this same range-bound area between about 6.9 and 7.1% since November last year.
Yep.
Since long before the Ukraine.
Yep.
So it wasn't the war that did it, as you say. It's already entrenched. It's already there, and it's not going anywhere, despite the fact that you've got headline inflation falling. So. I think that things are quite a lot more complex than some of these headline aggregate measures would suggest.
Well, it goes back to the fundamental attribution of inflation. It's more to do with the quantitative easing programs that the central banks did over a long period of time, and specifically post-COVID. That was where the seeds were laid, which isn't surprising if you think about it. More money going after the same assets. It sort of implies that you would get inflation. And I think that's absolutely right. The other interesting observation is there was a piece of work done by one of the feds in the US looking at specifically the rental component within the CPI. And they made the point that the rental component is the average of all rents, not new rents. Right. So in other words, it's actually really not giving a very good read as to what's really going on. It's about 6 to 12 months behind reality. And we know that new rents in the US are really rising very quickly. So there's a big splodge of inflation relating to rent still to come into the CPI numbers. So that lag effect is something else that some people may have not understood as well. So whilst people can claim that they've sort of reached the peak and it's now coming down, I've got some question marks for that as well.
Yeah, indeed. And it's not even about the peak as well as it's just, if it's just going to bounce around, like the PPI within a range-bound sort of area that's well north of the Fed's target, or even if it just comes down, but it comes down a lot more slowly than is generally anticipated, that's still going to cause some enormous problems. And the Fed's not going to be able to turn dovish on that. On that particular, with that in that environment,
unless they define a new range band. right?
Oh, you know what? Just our target's now 7%.
Exactly right. Yeah. We're good economic managers if we can get it between 5 and 7 rather than 2 or 3.
Yeah. Ballpark, perfect. Okay, yeah. Okay. Now you mentioned the Reserve Bank of New Zealand, which is very, very hawkish, which has been honestly fantastic to see. Just saying inflation is the number one goal. This is hitting people. This is hitting the economy. We need to do something about it, and we're doing something about it. They've already raised rates to 2%, as you mentioned earlier, and as you can see on the right, their economic data started to roll over. But despite their economic data rolling over relative to where people thought it should be, they're pressing on to what they predict will be a 3.95% cash rate in the middle of next year.
Yeah, absolutely. And it's interesting that the narrative from Adrian Orr has been very, very clear, right? That we have to do this and we have to do it quickly because otherwise inflation will get entrenched. And they did say, well, house prices are over where they should be relative to any long term of sustainability. So they need house prices to come back a bit as well. And of course, credit growth in New Zealand has gone into reverse significantly, particularly in the household sector. Listings, of course, have gone up as well. So I regard New Zealand as a little bit of a petri dish as to what may be happening. It's just they're doing it more quickly and more transparently. Kudos to them. We're going to sort of muddle around here in Australia much more. We'll do it more slowly and we'll hopefully not have the same results. Well, probably will just take a lot longer. But, it is really interesting. And it's interesting to see the political debate now hotting up. So what have they done? They've increased the opportunity for migrants to come in and get residency quickly to try and actually get migration to come in to help. And they've also increased the stimulus for first home buyers to try and get them to come and buy in the marketplace. Now, they've done that very recently, so they're already trying to pull the levers the other way as well, which sort of reminds me of the old adage of it's very difficult to drive a car when you're pressing both the accelerator and the brake at the same time.
Pretty much, mate. I mean, I think that's. I think I've been meaning to ask you. Do you think that we could see the RBA being forced to play catch up? Maybe some sort of 50 basis points hikes later in the year if we do start to, if we do continue to see the Fed, the Bank of England, and if the Reserve Bank of New Zealand being very hawkish.
I think there's a significant chance that'll happen, but there's two factors to bear in mind. Firstly, I think the RBA will be happy if the exchange rate goes quite a lot lower than it currently is, and it probably would in those circumstances. And like I said the other day, there was a comment to that effect. And the other is that they will argue that things are different here because the inflation rate in Australia isn't as big as it is in the UK or the US or even in New Zealand. Now, is that true? Or is it just we've got delayed data and, the inflation is there, but we're not seeing it yet? That'll be the other question to ask, because if inflation goes on going up, and I've seen people suggesting that the real inflation rate's probably 8 or 9 or 10%, that's probably closer for many people. But again, it's all sort of fudge because of the way they do it. So I think it comes back to the trajectory of inflation. But I do think there is a significant thought that the RBA has been asleep at the wheel for some time. Remember 2024? That was when rates were going to start going up. Well, that was only 6 months ago, right? Yeah. So they've sort of moved a bit. And they did a bit more last month than some people thought they would, which is why Westpac's saying 40 Tuesday after next. And I think that's probably more reasonable. So I wouldn't be surprised to see a couple of more significant strides in the cash rate, and then a pause, because they'll then want to see what the data is telling us before they do any more.
Well, it's going to be interesting one way or another. I mean, I think that the real wild card in all of this is what's going to happen to household confidence as rates do rise, because we like it's all and good. I mean, I've got an article coming out this weekend going, okay, this is quantifiably what's going to happen to X percentage of households if rates go to X percentage. But that's all well and good, but that doesn't tell you anything about what's going to happen in terms of confidence, which is obviously going to be the defining characteristic. And I mean, confidence is already in the toilet, yet we have record retail sales. So I don't know what to believe in that regard.
Well, on confidence, the Roy Morgan ANZ one
Yeah.
as low as it's been for a long time, right?
Yeah.
And that's consistent with the Westpac one as well. But the other thing to bear in mind is one of the reasons why retail is so big is because the cost of things have gone up. So, when you go to the supermarket, you're now paying, 10% more than you were a few months ago? That's something I'm not sure that people have fully understood. So there's two reasons why the volume of transactions, the total volume of retail sales go up. One is you buy more stuff. The other is you buy the same stuff, you pay more for it. It's a sign of inflation.
Yeah, no, I agree, but I mean, like, it's still well and truly outstripping inflation. I mean, like last month it was 0.9%, month on month growth, and I mean, if you give inflation sort of it's about 4, about 0.4%, a little over 0.4% month on month in terms of. So I mean, that's still pretty strong figures for an economy where confidence is in the toilet and people are just concerned about the future. I mean, you've even got Jim Chalmers, our new treasurer, saying that the economy is looking dire.
I know. Yes, and did you notice how he immediately threw the issue of the energy price uplift, which was announced, and said, well, the other guys should have done it before the election, but they postponed it right until after the elections, and they're trying to blame them for as much as possible.
Well,
why wouldn't you?
All part of the game. I mean, it's just like people talking about the Q1 GDP figure disappointing. If it comes in very weak, Labor can go, well, look at this. It's all part of the game, I suppose. Now, this one is one for for pretty much everyone, but it's also one especially for some of our Canadian viewers, which I know they do. Some of them do like our housing price content, and basically it's that housing prices in Toronto are getting absolutely smashed. Housing prices in Greater Toronto are down 8.9% in 2 months. In terms of when this data was collected, it was 57 days between the rate rise, this data snapshot. That's got to be some sort of record.
Yeah, and it's worth just saying, Tarric, that if you go back and look at the trend series, there was a very strong rise earlier on. They have the same sort of rise as we had here. So they've seen a very strong rise and a very strong correction, right? What have they seen in New Zealand? A very strong rise, rates went up, a strong correction. That, I think, tells you the path ahead.
Well, it certainly raises some interesting questions, doesn't it? Because I mean, like you and Edwin have obviously explored rather extensively the fact that some of the housing price indices that we have are lagging indicators.
Yes.
By however many weeks, and you've already got Sydney housing prices falling by nearly, pushing up towards nearly 1% for the month on month.
That's on average.
Yes. Yeah. Exactly. Of course, some places are faring much worse. So you got to ask, once we start to see these rate rises feeding through, are we going to follow New Zealand and Canada? Are we going to follow Wellington and Toronto and Auckland? Where housing prices are falling from between 2 points. It was down 2.7% in Wellington, and in some parts of and there was one report that based on the average. Now I know that averages mask and averages. There's a whole bunch of issues, but the average price in Toronto was down 6.4% in April alone. So it's just there's a lot of uncertainty there.
Yeah, and it's tis to the downside, and I think we're going to see more of that here. But that time lag is important to understand. So most of the indices are using data that's several weeks behind reality, right? And we're also seeing, of course, big variations. So there are still some places where people are still paying over the odds, and there are others where people are actually taking a significant hit in terms of prices. So it will settle, but I think it will settle lower. And I expect personally the rate of drop to continue to accelerate, and also spread to some of the smaller markets. Because if you look at the Adelaides and the Hobarts at the moment, they haven't really started falling back yet, although the rate of change is looking a bit weaker. So generally, what happens is it's the main markets first, and then it spreads out to the other markets. And I come back to the point I made earlier on: the rate of change of credit is also one to look at, because that's now easing back. So the last numbers that we got from the Reserve Bank showed that they were a little bit weaker than previously. I expect that to continue. And of course, the rates are continuing to rise, and the bank has tightened their lending standards, which means essentially you can't borrow as much as you could. So your borrowing power has already been reduced. And as rates go up, the borrowing power reduces even further. That's going to put a further downward pressure on prices, because actually the availability of credit is one of the key connection points to house prices. And what's happened in in the Canadian market and in the New Zealand market, in both cases, credit has been tighter.
Yeah, and I mean there was an interesting tweet today from Ron the mortgage guy, who some of you might be aware of on Twitter. A prolific individual, been involved in the industry for decades. A real, someone who's really got his finger on the pulse. And he was saying that 50% of appraisals were coming in under the value that it needed to be for these loans. Yep. And that's just an insane number. Just the idea that these, and not only that, but there's plenty of anecdotes from agents and from other people on Twitter that basically, some of these deals are falling over, and you got to wonder if we're going to potentially see the same thing here. I mean, obviously there are vast differences between Australia, New Zealand, and Canada, but they're also the closest analogs globally that we have.
Yeah, well, we're already seeing some of the valuations coming back lower than people expected. So I was talking to somebody earlier on today who had a pre-approval. It was a few weeks old. They went back to refresh the pre-approval, and suddenly the amount they could borrow dropped by about 10%. Big shock.
There you go. Indeed. Now we're on to the sort of even bigger picture stuff, and this one really speaks for itself. Food production versus food prices. Food production globally is falling, and food prices are, well, they're rocketing ahead, aren't they? That's just the way of the world at the moment. And this is probably the most concerning chart in the world for a government in the developing world.
Well, I was very interested that at Davos, I don't have much time for them generally, but they actually were this year talking some sense, and they were concerned about the impact of just precisely this happening, not just on Western countries, but on the rest of the world, the third world, those that actually don't have much spare capacity to spend more on food. And they were talking about hunger increasing and poverty increasing, and and the really dire consequences of that. I think it's quite significant that those topics were actually on the agenda this time.
Yeah, I do wonder how much of that was sort of driven by the fact that obviously a sizable proportion of the current issues are being exacerbated what's going on in the war in Ukraine. And I do wonder if that has sort of shone an additional spotlight on it, shall we say. But I think the problem is that a lot of these issues were baked in before the war in Ukraine, and they've been exacerbated enormously by it. And these problems are just going to echo around the world. And as we've discussed previously, the real risk here is that you get that feedback loop of negative outcomes of inflation, social unrest, impacted industry, impacted exports, inflation, social unrest, rinse and repeat.
Yeah, exactly. Interestingly, in the UK, they've just announced that they're going to allow the planting of certain genetically modified crops, whereas the EU haven't allowed that to happen, and so they're out of it. And that's again trying to get back to how do we increase more production. But also the other factor that I was listening to in another conversation was that the cost of fertilizer is so high now that some farmers are not just putting as much fertilizer on, so they're being less productive. Although they can grow stuff, they're not growing as much because the cost of growing it would be too high. They'd never get it back, despite the food prices. So, there are real big complexities here, and I don't see any easy way out. And I suspect it's going to get worse before it's going to get better.
Yeah, indeed. On to China. This is Chinese construction starts going by floor space. So this isn't distorted or anything by the number of apartments or apartments getting bigger or smaller, purely floor space being started. And basically it's fallen away quite significantly. Now we can obviously, state that a lot, that part of this would be obviously driven by Chinese lockdowns, because it's kind of hard to start a new apartment complex when you're sitting at home. But it also just goes to show that, and it's also the fact that part of this occurred before lockdowns, that it just shows a weakening Chinese construction sector, and that's not good news for for Australia and for our commodity exports.
No, and this is interesting to note that, of course, last year they cut the interest rate on 5-year money, which basically meant the mortgages in China were actually dropped by 15 basis points or something, which was quite a big drop. desperately trying to find a lever to sort of get the economy going. And I'm fascinated that the Chinese economy and the Central Bank of China is going one way in terms of monetary policy, and all the Western central banks are going the other way, creating this huge disconnect between the two. And that's one of the reasons why the exchange rates moved around pretty dramatically. But the property sector in China is just looking pretty weak. It reminds me of what happened in Japan about 20, 30 years ago. Massive collapse.
Yeah, well, exactly. I mean, and they've got they've got arguably the biggest real estate bubble in history. Relative to the enormous size of the Chinese economy at this point, and it's really something, because iron ore prices have been supported by hopes and dreams now for months. Yep. You've got record mill, you've got 2-year highs in steel mill inventories. You've got iron ore stocks piling up. You've got demand falling away, but there's still that hope. There's still that hope that the Chinese government is going to do this big, huge construction-driven stimulus, and then everything's going to be okay. Now, I don't know if that's going to happen or not. I think it's a big risk on their part. But for the moment, considering the fact that they've got all these issues with COVID zero, with lockdowns, with people, with businesses getting absolutely smashed, I would imagine that that's going to be where they're going to have to be forced to dedicate the lion's share of their resources.
Well, that's an interesting debate going on between Li and Xi, right, in terms of, how this all plays out. And there's that political angle as well. So once again, I think this is a highly political discussion as well as an economic one.
Yeah. Exactly, and that's a whole other show, the Li versus Xi debate.
Exactly.
This is arguably one of the major consequences of not only COVID zero, but also just the broader slowing of growth within the Chinese economy, and the unequal outcomes that have been experienced in recent years. And basically, it just shows that even looking at the US, youth unemployment in China is very, very high. Relative to the US, relative to Australia, relative to a whole lot of places. You've got to be looking to Europe to find significantly higher youth unemployment than China.
Yeah, that is interesting. And of course, it's just worth noting that the latest unemployment statistics showed a bit of an uptick in younger unemployment here as well. So it does seem to be that's where the action starts first.
Indeed. Now, this brings us back to the question of oil, which is obviously one of the major things. It's an input into inflation. It's an input into just about everything through transport, through fertilizer, etc. And the Chinese oil consumption, in terms of the number of million barrels of oil a day that they're refining, is down by about 1.8 million compared with the middle of last year. Now, that I think is quite interesting, just because we are seeing these enormously high fuel prices around the world, and China is shut. There's this huge swaths of China that are shut, that have extremely low levels of activity. Oil consumption in some of these places is practically non-existent, beyond some delivery drivers, etc. But I think that it's interesting that we still have oil at the time of the recording of the show at about $110, $113 a barrel, despite the fact that China's in lockdown, and we've got 1 million barrels a day coming from the US reserves.
Yes, and it's interesting because at one stage the oil price did come back, and it was actually coming back simply on the assumption that China wasn't going to consume less. Now it's all turned around, and in fact overnight the price was up quite strongly. So I think we're going to see significantly higher oil prices ahead. And if China does come back online, more demand, that's just going to put more power to where prices could go. And as we said earlier on, it's fundamental to pretty much everything that goes on, which feeds into inflation, which would suggest that controlling inflation will be even more difficult.
Yeah, exactly. And that's something I'm going to get to on the next slide. Now, on the left here, we have, this is US refinery capacity currently being used on the eastern coast of the US, and basically it shows that it's above the 20-year average. Sorry, is that 20 years? No, sorry, 30-year. It's slightly above the 30-year average. We're talking about nearly full refinery capacity being used on the east coast, Yet, despite the fact that refineries are running hotter than they have been in decades for this time of year, on the right there, you've got the transport fuel stocks for the US and what level of reserves they have to fuel their economy, to fuel for people's cars, for trucks, for planes, and it is at a historic low level relative to recent history, and that just goes to show that even though they're throwing all this capacity, all this oil at the refining sector, they cannot make enough fuel to rebuild those stocks for the summer driving season. And one of the most simple reasons why is that Europe is no longer buying as much Russian refined products as they were before. So the US is exporting all this diesel, all this gasoline to Europe instead of them buying it from Russia.
Yep. Yeah, and just remember, folks, what our lead time is to get fuel to Australia.
Yeah, exactly.
I'll leave that hanging.
Exactly, and I mean it's also just that this is what stocks look like now. We're in that lull before the US summer driving season, before people set off to go visit their families, to go on their road trips to Wally's World or whatever. It's what is it going to look like in 2-3 months' time, or in particular when the Strategic Petroleum Reserve is the release has ended, and God forbid Biden decides this year to rebuild the stock. So that's another 1 million barrels of oil a day that the world's going to have to find. So, I think that the oil thing is something that really needs to be understood to really get where inflation is and where it's going.
And then if you overlay the whole climate change debate over the top of that, right, where effectively oil companies would be encouraged to sort of disengage and wind down, then all of a sudden, no, we didn't mean it.
Yeah. Exactly, and oil companies are reticent to shift course now. They're gonna wring every dollar out that they can, and they're not gonna. I mean, it's like, why would you go exploring for more oil when you're being told that we're not going to need it? No. It's just it's a waste of billions and billions of dollars until it turns out that you need it.
Exactly.
Okay. Now, this is US bank deposit growth on a 3-month annualized basis, 6-month annualized basis, and year on year. And it shows that the 3-month annualized deposit growth is actually falling. So people, in aggregate terms, people are spending their savings. Now, this is something that I believe I had in last show when I was on here, that when I showed that chart of the people of 60% of American households burning through their savings to keep up with inflation. And this is now confirmation that is reducing overall savings in aggregate. So I think that's something that's really interesting, and I think that it's going to be what we really need to see is the granular breakdown.
Yep.
What are lower class households have already been smashed. A lot of them already have less savings than when the pandemic started. That was confirmed the other day by a data release from the Bank of America. But what is going on with middle class households? Are they burning through their savings, and are the wealthy still saving? So how is that going to balance out?
Well, that's what's happening here, according to my survey. So we've still got people who are accumulating more wealth, top end of town. The people at the bottom never had any wealth anyway, and that's hand to mouth, only more so, and they're using more credit to try and get by, particularly even things like buy now, pay later and credit cards. But the people in the middle are now starting to get squeezed, and they're raiding their savings and they're putting more on credit cards. So that group there, which is effectively, the typical middle class, it's certainly in Australia, they are getting squeezed. One of the reasons why the stress results are so high, because they're actually running out of runway. They can go on doing that for a bit, but unless wages really start to take off in real terms, and I think that's unlikely given everything we're seeing. The last Treasury real term growth for wages, 2024, I think. So no real growth for wages. People are going to run out of savings.
Yeah, exactly. Wouldn't it be nice if housing prices were lower and people didn't spend 12 years saving for a deposit? They could be spending in the economy, and we wouldn't be having this conversation.
Oh, but you can just pull out more equity, mate.
Oh, of course. How very un-Australian of me. Okay, now this is the last slide for the day. We've managed to get through all of them. and it basically shows this is the number of mortgages being taken out to purchase homes in the US as an index, and it has fallen to its lowest level since early 2019, and early 2019, excluding the obvious impact of the pandemic. So the US housing boom is very much coming to a close in terms of these fundamental underlying data. And that's been seen in new home sales. It's been seen in pending home sales. There are a bunch of different indicators all pointing in the same direction. And they're all saying this is the US housing boom is coming to an end. There was actually an article in CNBC this morning saying that vendors are getting worried about the market, so they want to get in now, and so listings are up. Well, I think it was 9% year on year.
Right, exactly. It's the same play bulk as we've got here, higher listings, because people are worried about the future of prices and they're trying to get out now if they need to. The other interesting observation, of course, is just to understand the average home price in the US is so much lower than it is in Australia, just unbelievably lower. But it's a volume game, and as mortgage demand comes off, as I keep saying, the rate of change of credit is the thing that drives prices, so you'd expect prices to slide, and they're already moving down in some parts of the US. And so you can see this whole sector of the economy beginning to turn over. And that's now going to be a really interesting dilemma for the Fed, right? Going back to where we came in, right? Panic on inflation at the moment. They might be okay to allow the stock market to come back 20, 25, 30%. Will they actually be willing and able to allow house prices to slide back because of the financial risk and financial stability risk that actually represents? That'll be the acid test.
My theory is that they'll be happy with it for a while, because I mean, as you mentioned in our last show, we don't have the same subprime lending issues. We don't have these balloon payments. We don't have, these variable, variable rate mortgages into these giant increases in interest rates. 90% of American mortgages are fixed on a 15 to 30 year term. So most of these, there might be a bit of jingle mail, from households who are underwater, who are underwater over time, but there's not the same level of issue there that's going to drive a very, very swift, very violent downdraft on housing prices, I think, not without a similarly challenging recession accompanying it. So I think the Fed will be quite, if for example, prices fall in the US in the same way they say they fell in Australia between 2017 and 2019. So you're talking about sort of like 10, 12% down over a couple of years. I mean, even 20% down over a couple of years. I mean, they can live with that over 4 or 5 years. But it's that, falling off a cliff, Wile E. Coyote moment that I think that they'll want to avoid. But I mean, as we've talked about before, I think it's going to take some time for that type of thing that type of scenario to potentially play out. I don't think that the fuel is quite there yet in the US in the same way that it is, say, in Canada or New Zealand.
No, I agree, and I think it will be a bit further down the track. But it's one to watch, and I think the other thing to watch that I'm looking is just this whole question of market liquidity, because actually wherever you look now, there's less liquidity. All right, and this is actually something else to just bear in mind, because it actually is affecting volatility in the markets. It's affecting prices in the market, and so from in the financial markets, there's also some rather interesting undercurrents now beginning to appear. And I'd actually argue that the recent crash of the stable coin is another example of that was actually underpinned by a bit of a structural financial engineering. That went wrong. Well, we've actually got a lot of financial engineering across multiple markets to support multiple markets when liquidity is down. That could be interesting too.
No, exactly. It's going to be, I suppose the key word this year is interesting. It's going to be interesting to watch, exactly. Because this is all real uncharted territory. The biggest QT in history, the ECB trying to raise interest rates without blowing up Southern Europe, and seeing bond spreads between the core parts of the Eurozone like France and Germany, and then the ones like Italy and Greece, and they're hoping to God that somehow they don't blow up the sovereign debt market again. And there's no guarantees, and I think that it all comes back to inflation, because if they can't contain inflation and they're forced to hike these rates, and they're unsuccessful in doing it with moderate rate rises, are they do they blink? Do they just stop raising rates and just hope for the best, and just hope and pray that countries and nations and the system just doesn't implode on itself? Or do they just keep hammering away, treating every problem as a nail, and just keep raising rates and raising rates and raising rates until finally they crush demand so significantly and so hard that eventually they do tame inflation?
Yeah.
Because they've just smashed it so hard into oblivion. And I mean, and that's the thing. People say, "Oh, you can't fix inflation with rate hikes." Yes, you can. You can. If you keep smashing away at it, if you had 17% interest rates tomorrow, like they were back in Australia in the 90s, I'm telling you, it would fix inflationary problems. You'd have a horrible recession, but you'd fix it.
Yeah. Well, that you shared, I think, the other day, a very interesting cartoon on Twitter, which basically had the Fed in a car, right, at 90 degrees to the road, stuck between inflation and recession with nowhere to go. That's how I feel at the moment that they are. I thought it was a very good summation of where we are.
Yeah, exactly. I mean, it would be miraculous if they managed to extricate the world and the US from not having a recession. And it's just we're trapped. And I think one of the really, really stunning things in all of this is that we've got growth rolling over in the US. We've got, even here in Australia, people talking about 0.1, 0.2% growth. And admittedly, that's because of some issues with supply chains, weather, etc. But things are not that fantastic. Yet we're running a structural $60 to $80 billion deficit. I believe that's what the ABC reported here in Australia. The US is running a deficit to the moon. And this is the best we can do. This is us with QE. This is us with all this stuff. Absolutely every stimulus measure you could possibly find imaginable. And we have crap wages growth. We have high inflation. And what do you want to do next time? I get the theory, that John and others have put forward that they're going to want to stimulate again, and maybe they will. I know they will once they've got the scope for it. But if they do that while we've already got all these accommodative things in place, both fiscally and on the monetary side, you're just going to yo-yo. You're just going to create more inflation, and we're going to be back where we started at the start of this year in no time.
Absolutely. And just to bear in mind, of course, that when interest rates go up, something else goes up, and that is the cost of government debt. All right? And the cost of government debt is a function of interest rates and the size of the government debt. Well, guess what? We've got big debt. The US has got big debt, right? So, in fact, the costs of just that big debt is also an overhang that nobody really wants to talk about, but I think it's a significant factor too.
Well, exactly. Rates go up, deficit goes up, and you've got even more problems. And then, not only that, but then the central banks and the governments want to do even more QE so they can get the interest-bearing debt off the government balance sheet.
Yes. My view is they dug a very deep hole, and they're right at the bottom of the hole, and they really don't have any way out, so they're going to keep digging.
Maybe they'll get to China.
Maybe that'll solve the problem. Tarric, I really appreciate your time today and all the work on the charts. Great work once again, and a very important conversation. And, we'll come back and do a bit more. There's always going to be more to talk about, isn't there?
No, certainly, mate. There's going to be... there's never a dull moment.
Exactly. Well, that's probably good for us.
Very true, mate. You have a good one.
Take care. Bye-bye.
Bye.